Good morning, everyone. Welcome back. This is day two. Okay, I am Paritosh Panchal. Now, today we'll be discussing the CAPM method to calculate the cost of equity. Now, before we begin, I request you to watch day one, which covers the tips and tricks for the exam of AFM and how to score those professional marks. Okay, so let's begin for the day. Now, cost of capital equity. So, the overall cost of capital is made out of, as the word suggests, it's cost of capital. So, all the sources of capital. So, equity is one of them, preference share is another, debt is another. So, individually, you'll find the cost and then get a weighted average, and that's how you arrive at your WACC. All right. Uh, so now, why do we need this WACC? WACC is required for discounting your NPV. Okay, so it is super important to have WACC. And the way in which WACC is calculated is by individually calculating your cost of capital. So we'll be discussing today how to calculate cost of equity with one of the most popular methods, that is CAPM. While appraising the potential investment projects, cost of capital, that is the discounting rate, is used to calculate the NPV. So WACC is the rate at which discounting is being done. Cost of capital represents the return required by the investor or the expected return. Okay. So cost of capital, as it said, that it's see, one would ask, how can it be equal to the return or the expected return? Well, think of it this way, that if a banker is say getting money, or like we are creating a fixed deposits. Okay, so we are basically lending money to the bank. The bank is paying interest to us. So we, as an investor, for us, it is returns earned. However, that same amount that we are earning as return is the cost for the bank. Similarly, if you think from a company's point of view, when company borrows money, okay, it is a cost of capital for the company, but investors who have given money to the company, for them it is return. So cost of capital is equal to your required return or expected return, because it's the one, like, so there are two different sides of the same coin. So total cost of capital is made up of cost of equity, cost of preference shares, and cost of debt. Cost of finance to the company is equal to the expected return of the investor and is expressed in a percentage. So cost will always be expressed in a percentage. To calculate the returns being demanded, we will assume that in a perfect market, market value of an investment is equal to PV of expected future returns discounted at the investor's rate of return. Okay, so in a perfect market where everybody has all information, okay, the market value of any asset, for that matter, would be the present value of all the various cash flows. Okay, so that is why if you see valuations, there is one method called DCF valuation, wherein we take the future cash flows and discount it to present value and then add it all up to find the enterprise value. Okay, so on the same logic, uh, any asset can be valued. In fact, if you have to find the market value of a bond, that's how we do it. We take the future cash flows, interest. At the end of the year, there's redemption, and then discount it at the yield, okay, or the investor's required rate of return. All right. So this applies to all assets. Now, risk versus return. It's often a saying in finance, higher the risk, higher the returns. Okay. When an investor is taking higher risk, why is he taking higher risk? Because to earn higher returns, he needs to be compensated for that risk. Okay. Therefore, higher the risk of an investment, higher is the return expected by the investor. Return required is a reflection of the risk the investors face. So, say for example, in the stock market, if there is a risky stock, for example, Tesla is considered risky. Why is it risky? Because it's into EVs, and EVs are still just catching popularity. We don't know whether EVs would continue, whether some other technology will come into play. Okay, there are hydrogen cell cars, there are hybrids. Okay, there are a lot of futuristic things that Tesla is doing, which may or may not pay off. Therefore, high risk. However, the shareholders of Tesla are prepared for that risk. Why? Because they want higher returns. Similarly, if you think of it from a debt point of view as well, long term debt is high risk. You are away from your money for a longer period of time. Therefore, you want to be compensated. So, long duration bonds would have a higher rate of interest as compared to, say, 1 year bond. Okay. The total returns demanded by an investor is actually dependent on two specific factors. Now, we are looking from strictly equity point of view. So, firstly, the investor is going to say, I at least, if I'm going to invest in equity, and equity is considered risky than debt, we are going to say that minimum I want risk-free rate. Okay. And over and above that, since I'm investing in the equity market, I want the market premium. Now, understand that we are not investing in the entire market. When we say the market, so in India, you have something called the Nifty 50. In the US, you have S&P 500. In UK, you have the FTSE 100. Okay, these are all benchmark indices. Okay, these are nothing but average of certain top stocks. So, for example, Nifty 50 is the average. Now, it's not a simple average, it is a weighted average. Okay, weighted average of the top 50 companies in India. S&P 500 is top 500 companies in the US. Nasdaq 100 is the top 100 companies in the US, majorly tech based. Okay. Then you have FTSE, the top 100. FTSE 100 is the top 100 companies in the UK. All right. So that's market return. So what is market premium? Now, if historically, if you have observed that the markets are giving around 10, 12%, okay, let's assume that the markets give 10%. And the risk-free rate currently is, say, 6%. Okay, so 10 minus 6 will be 4%. That is the market premium, which means that if you are investing in the markets, you need this premium. You earn this premium. Why are you earning this premium? Because you are investing in the market, which is riskier than the risk-free rate. Okay, so the first thing you need is the risk-free rate. Say the bond. Now, how do you find? Okay, let me just practically show you what the risk-free rate is. Okay, so you will just say for example, for India, and say you want to invest for the next 10 years into the stock market. So India 10-year bond. Okay, so if you see the 10-year bond yield of India, it is currently 7% or 7.2%. Which means that if you want to invest in the market, say if you want to invest in Nifty 50 for the next 10 years, the minimum rate that you require is 7% or 7.2%. If you get anything less, it's not worth taking the risk. You will say, I might as well just invest in the bond market, in the government bond, and the government bond is the safest for me. It is risk free. It's considered risk free. Okay. So, or the US, so you can just use the US bond yield or the UK bond yield, whatever. I'm just giving you an example of India, right? So, 7.2% is the Indian bond yield. Then you will take how much the markets are giving in return. Okay, so you will study for the last 10 years how much is Nifty 50 giving as a return. And you find out that okay, Nifty 50 is giving me around 10%. So 7 minus 10 is equal to 3%. Okay, so you will say that risk-free rate 7% I need minimum. Over and above that, I need the market premium, which is 3%. So total, your expectation is 10%. However, you are not investing in the markets. You are investing in a stock. Okay, so the stock has its own risk. which is different from the market risk, and that risk is called beta. Okay, now before we discuss beta, let's just read the presentation. The additional returns invest. So the expected return by an investor in the equity stock would be firstly the risk-free rate plus an additional returns for the extra risk that the investor is taking. The cost of debt is cheaper than the cost of equity to the company. We already know that. We have been studying that all throughout finance, that cost of debt is always cheaper. Why? Because it enjoys a tax shield plus it is a fixed cost. Okay, this is because interest on debt is paid out before dividends on shares as paid. So your debt is low risk. Reason, one of the other reasons is that there is a security involved. In case of liquidation, debt holders are paid first. Also, in general operations, your interest is paid first before dividends. Okay. So, whether the company has the money or not, interests are always paid. So, and in case if interests are not paid, okay, there is always a security which can be sold, okay, and recovered the amount. And in case of liquidation, also, debt holders get paid first and equity holder last. Okay, so this is because interest on debt is paid out before dividends on shares are paid. Therefore, the debt holders are taking less risk than equity holders and thus expects less return. Now, systematic and unsystematic risk. So broadly, there are two types of risk. One is systematic and the other one is unsystematic. Systematic risk, as the word suggests, is built in the system. Okay, systematic risk is the risk that will affect the entire market, okay, or maybe even an entire sector. So say for example there is inflation in the country or deflation in the country, or there is some political unrest, or there is some war or something, so it's going to affect the entire system as a whole. Or there is some policies brought out against tobacco or liquor, okay, or alcohol, so it's going to affect one entire sector, right? Systematic risk. Unsystematic risk is not affecting the entire system, it is unique to your company. For example, if your company, one of the factories got fire, okay, or say your debt to equity structure, okay, or say uh, s- your employee, the union has gone into for a strike, okay, or whatever, some defective products were manufactured, there was a product recall because of which, okay, anything, so it's specific to your company. So when considering the returns investors required, the trade-off with the risk is of fundamental importance. Risk refers not to the possibility of total loss but to the likelihood of actual returns varying from those forecasts. So understand, now, when we say risk, we refer to variability. See, another measure of risk is standard deviation, or variance is a measure of risk. Okay. So, your variability in returns. Risk, often people think that, oh, risk means that it's a negative thing. Okay. Risk means down, lesser returns or negative returns. No, that's not risk. Even abnormally high returns. Why is that possible? Because there's high risk. So if you see company like Tesla, okay, the returns also what the investors are earning are much more in a company like say Meta or Apple or Microsoft or ABC, Alphabet that is. Okay, so um, why is that? Because it is risky. All right, and risky in the sense it could lose money very quickly, it could make money very quickly. There's a huge volatility or variability or standard deviation in the stock price. Systematic risk and unsystematic risk are two types of risk that affects investment and security. So total risk is a summation of systematic plus unsystematic risk. The risk a shareholders face is in a large part due to the volatility of the company's earning. This volatility can occur because of two reasons. One is systematic risk and the other is unsystematic risk. Systematic risk arises from the economy and external factors that affect the entire market or the segment. Okay, so a lot of external factors at play. Systematic risk is a risk that's inherent in the market and therefore it's also called market risk. Okay, it affects the entire market, therefore market risk. Now, then the next one, okay, so systematic risk will affect all companies in the same way, although to a varying degree. For example, a vast majority of the companies suffer in a recession, but not necessarily to the same extent. So another example I can say is during Corona, okay, not all companies uh, suffered equally. If you see like an automobile company or a real estate company, they had a very tough time. All your luxury clothing and all of them had a tough time because why? People didn't want to spend much. However, your um, basics, okay, your utilities like your electricity, your pharma companies, your FMCG companies, they were not as affected as a car manufacturer or a real estate company. Okay. Why is that? Because certain companies are safer. Okay. So systematic risk does not necessarily affect all companies equally. They are going to affect. See, it wasn't that FMCG companies or pharma companies were not affected. They all were affected, but to a varying degree. Restaurant sector was more affected. People had stopped going out to eat, right? Movie, the cinema sector, right? Entertainment sector. Then things move to OTP, whatever. Okay. Now, systematic risk includes interest rates. Okay, before that, the example. So, a car manufacturer may typically suffer more than a shampoo manufacturer during recession. Now, systematic risk includes interest rates, inflation, purchasing power, war, and other market risks. Okay, so affects the entire nation or the market. Systematic risk is non-diversible. It cannot be controlled and unavoided. However, systematic risk can be mitigated by asset allocation. Okay, you cannot. This is the systematic risk is also called undiversible risk. Okay, and unsystematic risk is diversible risk. Okay, so when we say diversify your portfolio, okay, a lot of time they say, okay, buy several stocks. So, say for example, if you have to diversify your equity portfolio, you'll buy one or two stocks from the banking or the BFSI sector. Okay. You will buy one or two stocks from the IT sector, one or two stocks from the manufacturing sector, one or two stocks from the pharma, from the FMCG, from IT, from oil manufacturing, chemical stocks. So you will diversify. When you diversify, you will take care of your unsystematic risk, which affects a single, company. However, if you want to diversify or you want to reduce systematic risk, okay, now systematic risk cannot, like, see, when the markets, when something happens, say interest rates are rising, there's inflation, all of your companies will get affected. So you cannot reduce the systematic risk by diversifying within the same asset class, but you can diversify by investing in different asset class. And not only like, so this diversification is not going to really um, solve your risk or take fully care of your risk, but to a great extent you can mitigate that risk, bring that risk down by diversifying in your assets. So you are investing a little in gold, little in silver, little in stocks, little in the real estate, okay, little in, say, cryptocurrencies. So you have various asset class within your portfolio. Okay, so diversification can be between asset class, and within one asset you could have several other, as in more diversification within a single asset class. So when it comes to equity, you can buy companies from different industries which may be unrelated to each other. In case of real estate, you can buy properties at different uh, geographical areas. Okay, bonds, you can buy bonds of different maturing or bonds of different companies. Okay, then if it's commodities, then different commodities. Okay, you can also invest in forex. A lot of things are there. Now, yeah, so we read this. Now, moving on, unsystematic risk arises from the uncertainties and internal factors that are unique to the specific industry or a company. Unsystematic risk factors do not affect everyone. It is specific to an individual company or the management or the financial obligations or location. Okay, it could be even a specific location. It's going to affect only one state. All right. So if the state government has come up with a new rule, okay, or a new policy, then it's going to affect only factories which are set up in that particular state, not the entire market, which exists all over the nation. Okay, or a management says one of the top board members is alleged for some wrongdoings. Okay, so the markets or that stock is going to have a beating. Okay, so examples of it is employee strikes, higher cost of operational activity, shift in management, product recall, all of that we discussed. Unsystematic risk includes financial as well as business specific risk. Okay, so what is unique to the company is the debt to equity structure. So that's your financial risk and your business specific risk. Okay, business specific risk, as in what you are doing. Say if you are in the sector of selling a particular drug, okay, and there is a new drug which is better than that, so then your business gets affected. Unsystematic risk can be mitigated by portfolio diversification, investing in shares of different companies belonging to the different sector or same sector, and thus also called diversifiable risk. Okay, now say for example the drug example which we just took. Now, if you have invested in the company that was producing the old sort of medicine and the company that is producing the new sort of medicine, then if you are making a loss in one company, you are going to make a profit in the other. And you have kind of diversified your risk. So you can diversify within the same sector as well. Okay. One may mitigate unsystematic risk by buying different shares of another company, either in the same industry or different industries. For example, a particular oil company has the unsystematic risk that they may drill little or no oil in a given year. And investors can mitigate that risk by investing in several different oil companies, because if one company failed to drill oil or was unable to find oil, well, other companies are there who would be finding and will make a profit. Okay. Or you can invest in a company which has nothing to do with oil, for example, your IT industry. No correlation with oil, or pharma company, little correlation to oil. Okay. Reducing the risk in this way is known as diversification, that is, by investing in different companies. Now, when investors can reduce risk by diversifying to hold a portfolio of shareholding, which, since shares in different industries will at least to some degree offer differing risk and return profiles over the year, which is basically saying that if you have a portfolio of stocks, you have diversified your unsystematic risk. Now, in order to do this diversification, how many stocks are recommended? Around 15 to 20. Say, for example, you have 20 different stocks in your company, in your portfolio, and say it has an equal weightage, which means that it has each individual stock has a 5% exposure. Okay, one company total exposure 5%, so 20 stocks, that is 100% total. Okay, so worst case scenario, worst, like it's very rare for a company's stock price to become zero, but worst case scenario, from whatever the price is of a stock, it turns zero, 100% loss. Okay, in such a worst case scenario, your portfolio is down only by 5%. Okay, so if at all there is any unsystematic risk which is so grave that it led to shutting down of a company, in such a situation, all you are going to lose is just 5%. Okay, so around 15 to 20 is a good portfolio to have. 15 to 20 stocks is a good portfolio to have. Anything beyond that, 20, 25 at most, anything beyond that is over diversification. So if you see a lot of these mutual funds which have like 100 stocks in their portfolio, okay, they are way over diversified. That is why mutual funds move very slowly. They are so diversified. So out of 100 stocks, there would be, say, 20 stocks doing great and 20 stocks not doing great. And then there are the balance who are not doing anything, as in they are very neutral, little up, little down. Okay. So overall, your portfolio, your mutual fund is just flattish. So that's why a lot of people, when you look at your mutual fund returns, okay, feel that the growth isn't as much. But if you look at now, again, in mutual funds, also there are different types of funds. So certain funds do make good return, usually the focus funds, okay. I wouldn't say good returns, but I would say there is more volatility in their return. So it could go up also quick, it could come down also quick. Whereas a typical mutual fund with more than 100 stocks, their moving is slow. If they go up, they'll go slow. If they come down, also they will come down slow. They are safer, okay, lower risk because over diversified. So this is the portfolio effect. All right. So this is your total portfolio risk if you have only one stock in your portfolio. Okay, so it is made up of both your systematic risk as well as your unsystematic risk, and the each additional stock that you add in your portfolio is going to bring down the unsystematic risk, because by diversifying your portfolio, you are bringing down the unsystematic risk. Okay, after 20 stocks, whatever unsystematic risk had to be mitigated is fully mitigated. Okay, and then anything beyond, if you're holding, is just for your satisfaction. Okay, it's not really bringing down any unsystematic risk. Okay, it's already come down to zero. So after 20 stock portfolio, the only risk your portfolio is exposed to is the market risk, that is the systematic risk, right? Now, just a moment, let me just see the video feed. Yeah, it seems proper. Let me just check on the YouTube screen if everything is visible or not. Just a moment, just a quick check. Right? Yeah, it seems proper. Okay. Yeah. So, a rational risk-averse investor would wish to reduce the risk they face to a minimum, and therefore, it is assumed that they basically have at least 15 to 20 stocks in different security or in different stocks, and thereby they are able to eliminate any unsystematic risk, or basically mitigate any unsystematic risk. Only so they only need to be compensated for the systematic risk they face. Now, why did we speak at such length about risk is, see, when we looked at the expected return of a shareholder, imagine we are the shareholder of a company. Okay. Now, say we want to invest in Tesla. We are going to say that firstly, I want the US Treasury yield, okay, a 10-year yield. Say I want to invest in Tesla for the next 10 years. I want my minimum US Treasury yield, whatever that is. Okay. Um, Plus, I need to get compensated for the risk that I am taking while I'm investing in Tesla. Okay, now what they are going to say is that, all right, we understand that you are investing in Tesla and it is risky and you need to be compensated. Okay, so how do we measure what is that extra? Okay, that depends on the risk. Now, risk, as we studied, are two types, systematic and unsystematic, out of which we are saying that it is made as an assumption that the investor has not only Tesla in the portfolio, but also has all the other stocks in the portfolio. Also, from the tech space, has Apple and say has Microsoft, Meta. Okay. Then, other than that, has maybe say GM. and has say Johnson's and Johnson's, uh, JP Morgan Chase, Goldman Sachs, okay, Visa, Mastercard, so it has a very diversified portfolio. Okay. So which means that the unsystematic risk is already taken care by the investor and now needs to be just compensated for the market related risk. Okay. So that is the systematic risk. This method also calculates the cost of capital. That is CAPM method calculates the cost of capital. Now, this is where risk ends. Okay. And now moving on to the CAPM. This was like the backstory, or this was just forming the base for CAPM, because if you see the CAPM formula, it is risk-free rate plus beta into market premium. Okay. The second half is the entire risk component of the company. Um, so yeah, this method, that is the CAPM method, also calculates the cost of equity, just like DVM or dividend valuation model is another way of valuing or finding out the cost of equity. Okay, which had to do with taking all the dividends. Okay, so the one of the base case assumption was that it's just that the dividend that needs to be paid to the shareholder, that's why that's considered as a cost. And based on that, the DVM model was arriving at the cost of equity. However, capital asset pricing model is based on the fact that share price appreciation is what should be the cost and not dividend. Okay. Now, this looks more closely to the shareholder's rate of return in terms of risk. The more risk a shareholder takes, the more return he will want. So the cost of equity will increase. For example, a shareholder looking to a new investment in a different business area may have a different risk altogether. See, each and every individual has a different risk tolerance. Okay. Say you are more risky. I am not so risky person in general. So you are open to investing in a company like Tesla, but I would say no, Tesla, the volatility is too much. Or you are open to invest in cryptocurrencies with huge standard deviations. Okay, I, on the other hand, am much older and would say that no, I am not prepared for such a volatility. Okay, the standard deviation is just too high, the risk is just too high for me. So I will invest elsewhere. Okay. So, or maybe I'll invest in a stable coin, like I think USDT Tether. I think now I don't know whether Tether is still at play or not, but a few, at least a year back, there was something called USD Tether, which basically 1 Tether equals $1. Okay, it was stable. It used to move with the US dollar. Whereas Bitcoin volatility, and then your Luna and all those other cryptocurrencies, all the more volatility. Okay. So similarly in the stock markets also, I just gave you an example of cryptocurrencies because of late, that's the more in thing. Students relate to crypto world more because it's more in the news. But the stock market, if you had to look at it that way, so your Apple and your Microsoft are more safer as compared to Tesla. Okay. Moving on. So the required return is the risk-free rate return plus the risk premium. This is the base of a CAPM model. So risk-free return is the minimum return required by all investors from an investment whose returns are certain. So for example, a treasury bill or a government gilt. Okay. The formula for CAPM is expected return of an investment or cost of equity is equal to risk-free rate, that is RF, plus beta of the investment or the stock. Okay, so beta I, and this is the equity beta. Okay, so there are two types of beta. We'll come to that shortly, but the beta that we require is called the equity beta or the geared beta. Okay, and into RM minus RF, which is the market premium. As a whole, RM minus RF is called a market premium or equity risk premium. That is the premium that you need to have if you are investing in the equity markets. All right. Individually, RM stands for market returns. So if you had to like say uh, For example, if you are investing in Tesla, so if you know that the risk-free rate of return for US Treasury yield, I think, let's see how much is the US Treasury yield right now. So US Treasury 10-year yield, 4.2%. Okay. So what you are going to expect, firstly, you will say that I want 4% for sure. Then I want to be compensated because I am investing in the equity market. So what is that extra that the markets are giving as a return? So if you study for the last 10 years, you would find out that the S&P 500 is giving a return of, say, for example, 10%. That means 6% is extra that you are expecting. So 4% risk-free rate and the market premium, that is 6%. So total 10%. However, you're not investing in the markets. You are investing in Tesla. So now you need to find out. So beta, okay. Now beta is unique to every stock or every company. So a beta of Tesla would be different as compared to beta of, say, Apple. Now let me just show it to you practically so that you realize whatever we are studying is very much real and is applied in the real world. And how do we apply it rather? So if you just go to Yahoo Finance, okay, so I have Apple computers over here. So if you see the beta, this is a 5-year monthly beta of Apple computers is 1.29. If I do it for Tesla, okay, it is 2.07, which means Tesla is twice riskier or 2 times riskier than the markets. Okay, the market could be maybe Nasdaq 100 or S&P 500, whatever the benchmark they have taken. Okay, so Apple is risky by 1.3 times or 1.29 times than the typical average market. Okay, so what you are going to say is, I'll just close this. That not only do I want that 6% additional market returns, but I am investing in Tesla, which is twice as riskier than your average market. Okay. So I am expecting 6 into 2, 6% is the market premium. Okay. Into 2, because Tesla's beta is 2 times, that means 12% is the extra I want to be compensated for my risk. So 12% plus 4%, that 16% is what the shareholder is expecting for Tesla. Now, again, it's based on various assumptions. Assumption number 1 is whatever market premium we have found, RM, okay, RM minus RF is proper. Another assumption is the beta that we have taken for Tesla is proper. Now, in fact, if you go to different websites, the beta for Tesla will keep changing. Okay, because it's a little difficult to come and arrive at beta. We'll discuss beta shortly. I think maybe in the next, yeah. So beta is a measure of systematic risk of an investment. Okay. So in the CAPM model, there is a base case assumption that is being made that the investor is a rational investor and has invested in a portfolio of stocks. So that means there's a base case assumption that the investor has a diversified portfolio, which implies that the unsystematic risk is already taken care of and now needs to be compensated only for the systematic risk. And beta is a measure of systematic risk. Okay. So beta is equal to systematic risk of investment I, that is beta I. Okay. So I being the name of the stock. Okay. So 2 is the systematic risk, or 2 times is the systematic risk of Tesla stock as compared to the market. and therefore the amount of premium needed. Okay, which means that when we say that the beta of Tesla is 2, is basically saying that if Nasdaq 100 or S&P 500, whichever the index it's being pegged to or is being compared to, okay, if the index moves 1%, if it moves 1% up, then Tesla is expected to move 2% up. Would it actually move 2%? That nobody knows. But the expectation is that it will move 2% up. Okay. And if the markets move 1% down, the expectation is that Tesla will move 2% down. Again, expectation. Will it actually move 2%? We don't know. All right. So that's the meaning of beta. Now, how do you calculate beta? Well, you will find out the correlation basically. So, over the last, if you saw in Yahoo Finance, they had mentioned 5-year monthly. Okay, so month on month for the last 5 years, how has been the movement of the index and how has been the movement of the stock? And what they realize is over the last 5 years, at least on a month on month basis, if the index has moved up by 10% or down by 10%, the company, that is the stock Tesla, has either moved up by 20% or fallen by 20%. Okay, that's what they have observed. That's the correlation that they have observed for the past 5 years. Does that mean for the next 5 years also it's going to hold true? Nobody knows. So with new data available, this beta will get recalculated month on month. Okay. So beta measures the systematic risk of an investment compared to the market. The beta value of UK companies traded on the UK capital markets can be readily found on the internet. So I gave you one example of a US company, say for example, Barclays. If you just do Yahoo. So on Yahoo Finance, you will get everything. Okay, say Barclays. LSE is London Stock Exchange. All right, beta for Barclay is 1.34. Now, if you say Unilever, okay, now Unilever, London Stock Exchange. Unilever's beta is 0.17. Okay, 0.17, which means Unilever is safer than your FTSE 100. Okay, which basically is saying that this has lesser risk than the market. So, since you are taking lower risk, you want you are okay with lower returns. So, typically these are called defensive stocks. Pharma, FMCG, considered as defensive. Why? Because people are going to continue buying these products irrespective of the market conditions. Okay, so let's. So I just showed you how to view beta. So you can actually do this in your own personal investing journey, wherein if you want to invest in a company, you first look at the beta and you can understand what sort of volatility this stock entails and what sort of returns can you expect, or rather you should be getting. And if you're not getting that sort of returns, you may want to change the stock. Maybe it's too risky and you're not fairly being compensated for the stock, right? So if your expectations are not being met, move on to another stock. Beta is equal to measure of systematic risk of the investment compared to the market. The beta value of UK companies traded on the UK capital markets can be readily found on the internet. It just showed you investors may want a return higher or lower than the average market return, depending on whether the share they are investing has a higher or lower than average risk. See, since you're not investing in the market, you do not expect market return. Since you are investing in a particular stock, and that particular stock may be, now market returns are average returns. Okay, now if you are investing in, say, Unilever, the risk is below market risk. Whereas if you are investing in Barclay, it is almost market risk. It was just 1.2. If you're investing in Tesla, high risk, 2 times. Okay. So higher or lower requirement compared to the average market premium is called beta. If an investment is riskier than average, that is, the returns are more volatile than the average market returns, beta will be greater than 1. Okay, so like Tesla, it was 2, highly risky stock or an investment. If an investment is less risky and the average, then which basically means that the returns are less volatile than the average market returns, then your beta will be less than 1. Like Unilever, which basically says that if the markets are moving by, say, 1% up or 1% down, okay, Unilever stock will just move by 0.2% up or down. Okay, that means beta is less than 1. So lower risk than average. And beta, if it is equal to 1, okay, so in the markets and on the streets, we call these aggressive stocks, beta greater than 1. Okay. Beta less than 1 is considered defensive stocks. So in the news or in office, if you are in the world of equity and the markets, you will hear these terms: aggressive, defensive sectors, okay, and neutral sectors. If an investment risk is same as the average market risk, okay, then they are called neutral uh, stocks. If an investment is risk free, then the beta is 0. Okay, so we could say that Barclay is kind of like a neutral risk because it almost won. All right, your Unilever would be defensive and your Tesla will be an aggressive stock. And if the beta is 0, that means the investment has no risk. Okay, like for example, the beta for a risk-free rate, so for a government bond will be 0. Okay, CAPM is based on a number of assumptions. So if you remember, in our yesterday's session, we discussed that we need to list down assumptions being made when you are, calculating uh, your NPV. Say there is a report you need to find. You have been asked to find out whether this project is worthwhile or not. Okay, and for that you first have to find out the WACC. Okay, once you find out the WACC, so in order to find out the WACC, you found out cost of equity, cost of debt, found out the WACC. Using this WACC, you discounted the cash flows. Then you arrive at the NPV. Now, based on the NPV, you gave out a conclusion. Okay, but while calculating your cost of equity through the CAPM model, you made certain assumptions. Okay, so these are the assumptions which we are going to discuss shortly. These assumptions should be mentioned. All right. So the CAPM, or if not all, just say that. Make the examiner aware that you are very well versed with CAPM and you know that this NPV is based on the WACC being calculated. The WACC is based on the cost of equity, cost of debt, and cost of equity. We use the CAPM model to arrive at the cost of equity. And the model itself is making assumptions. So we in specific have not made any specific assumption. However, the model has made these assumptions, and I'm just making you aware that all these calculations hold true if the investor is well diversified, if there is perfect capital markets, there's unrestricted borrowing and lending at risk-free rate of return, and so all forecasts are made in context to a single period transaction horizon. Okay. And then there was also some skepticism wherein you can say that CAPM model has made an assumption of unrestricted borrowing and lending at risk-free rate of interest, which is not necessarily true. So your cost of equity, your actual cost of equity may slightly vary. Okay. Now this is actually nitpicking things, but just to give you an example, right? So you need to mention all these things. So these are the assumption, well diversified investors. So means that investors have taken care of their unsystematic risk through the portfolio, diversified portfolio. The capital markets are perfect, which means everyone knows everything properly, as in information is known to all and is being interpreted in the same way. There's no unrational behavior. Okay, unrestricted borrowing or lending at the risk-free rate of interest. This actually is not true. In fact, even well-diversified investors, we don't know whether it's true or false. There are no perfect capital markets at the moment. At least we believe that we are strongly efficient, not like fully efficient, but there is a strong, efficiency in the market, but not a perfect efficiency. Okay. Now, unrestricted borrowing and lending at the risk-free rate, highly unlikely because each company is able to lend and borrow at different rates. Okay. Usually, it's the base rate plus some spread. All forecasts are made in context of a single period horizon, time horizon. Okay. Which again is difficult. Advantages of CAPM, it works very well in practice. It focuses on systematic risk. It is useful for appraising specific projects. The disadvantages are that they are less useful if investors are undiversified. So all the assumptions which are taken, which we have assumed, okay, ignores tax situation of the investor. Actual data inputs are estimates and may be hard to obtain. Okay. See, risk-free rate is fairly stable. Okay. It moves, but not to a huge extent. However, market returns can keep changing and beta, most importantly, can keep changing. Okay. So our inputs itself are based on estimates. Now more on business and finances, because now we'll be doing something called gearing, ungearing and degearing. So see, as long as you are in the same sort of business, okay, you are able to use your old cost of equity. And as long as your debt to equity structure doesn't change drastically, you are borrowing from a pool of funds. Okay, you can use your old WACC, which is based on your old cost of equity and cost of debt. However, if you are venturing out into a new type of business, okay, or your debt to equity structure is changing, then your beta is going to change and you would need to recalculate your beta. Okay, that is the gearing and ungearing. Those who have already studied AFM would know what I'm talking about. Okay, and almost it's like a for sure, like a lot of questions involves us to ungear a beta and then regear the beta. Okay. So, if it is a financial manager's role to balance the different risk factors to ensure that the overall risk faced by the equity investor is acceptable. It is the level of overall risk that will determine the rate of returns that the investor will demand. Now, there is business specific risk. This risk is divided into two. One is the operating risk, and second one is the financial risk. Operating risk has to do with your fixed costs and your operating costs, so variable costs, your fixed costs, okay, costs basically. And financial gearing has to do with your financial costs, like the cost that you are paying for your debt. Okay, so both operating gearing and financial gearing is focused on the fixed costs. In case of operations, your fixed costs are your, say, for example, rent that you have to pay. Okay. And in case of gearing, your fixed cost will be the interest that you have to pay. So irrespective of whether you do business or you do not do business, you have to pay rent. You have to pay maybe salaries to the top management, not the bonus, but their basic pay package. Okay, And in from financial instruments point of view, you have to pay fixed returns to your debt holders, okay, your bond holders, your loans, okay, to preference shareholders. The dividends are fixed, okay. So the component of your fixed financial obligation or interest. In reality, there is little that a financial manager can do to alter the business risk, and may only be limited opportunities for altering operating gearing. Okay. So, see, there is very little. Now, whatever the risk of the business is, it is the risk of the business. There isn't much that the manager can do about it. See, cause the way it is structured, it has to be incurred. If it depends from sector to sector. So if for example, if you are in a service-based industry, okay, like the IT services, whether the company does great or doesn't do great, it has to still pay its employees. Okay, so it will have higher fixed costs. Okay, as compared to some other sector, say a small retail store. Okay, like your 7-Eleven. Now the store is not like a huge shopping complex that it has a huge rent. It has a small rental. Okay, and you may be having one or two staff member over there, and that's it. Those are your fixed costs. If you are not running the business, say during Corona, and you have decided to shut the shop, okay, the rental expense is smaller as compared to an IT company, which would the employees may not be working, but they will still have to pay salaries. Okay, or are working from home, but there is in business, but they would still have to pay salary. Okay, that means that in IT sector, the component of fixed cost may be much higher as compared to a retailer. Okay, retailer makes most of its costs in the inventory, and whatever inventory it has at a given time, that's fixed. Now if it's not being sold, it does not have to pay again for that inventory. It's just one time cost that they have taken. Inventory is a function of your sales. If you're selling more, you will keep buying more and more inventory. It is therefore the risk associated with how the company is financed, and it is most easily controlled. But what is better in our control is the financial risk, how much debt to equity we are taking. Again, to a great extent, uh, that is also not in our control. See, if you need funds for any new project, now it's either you do the project or you don't do the project. If you do the project, it is a NPV positive project. You will be making, you will get more value out of that project. Okay. Now, funding, if you are not able to get funding through equity, okay, that is, you go out there, you are trying to get equity capital, but people are not getting convinced on your project, then you are forced to take debt. Okay. Um, so it is controllable as compared to operating gearing or operating costs. Financial costs are better in our controls. Okay, a firm must consider the volatility it cannot avoid and ensure the gearing decision it takes to avoid increasing risk to unacceptable level. Okay, so a firm must consider the volatility it cannot avoid, the risk that it cannot avoid, and ensure. So your operating gearing, you cannot avoid that. Say you are venturing out to a new field of business. Say if you were initially manufacturing, like for example, Reliance Industries started off with being a petrochemical person, okay, and now is into telecom, is into retail. So what is the risk of telecom, risk of retail? Now, in case of telecom, your fixed costs are huge, very high operating gearing. Okay, you have to first, it's very capital intensive. Okay, so now whatever, if you have to pay for a cell site is again, it's a technical term. So the tower, okay, the telecom tower. See, you are not erecting your own tower, you are renting out a tower. Okay, so on a tower, you are buying a space to put in your disk or antenna or receiver, whatever it is called. Okay, so that's called a cell site. All right. So now whether your operators are increasing, your users are increasing or reducing, you still have to pay rental to that tower company. Okay. So uh, that's a business risk of the telecom sector. Cannot avoid it, but it will try to take it will try to control things which is in its hands, like the debt to equity. So the gearing can be to some extent controlled to avoid increasing your risk to certain unavoidable, unwanted or unacceptable levels. Now, when we use WACC to appraise investment, the WACC calculation we made earlier are all based on current costs and current risk, the current debt to equity structure. Okay, it's based on the current business risk, the current financial risk. So we can only use this for any other future projects only if our debt to equity remains unchanged, that is our financial risk is unchanged, and our operating risk, that is our business risk, is unchanged. If either of these two change or both changes, we will have to recalculate WACC. That means we will have to recalculate cost of equity, cost of debt. Okay, and also if finance is, so in your exam, okay, when do we recalculate our cost of equity is when the debt to equity structure changes, when we are entering into a new field of business, okay, and when your project is not, so your finance is not project specific. Okay, so the average is applicable, otherwise the project may be best valued using specific cost of finance. Okay, usually it is assumed that whatever project you are doing is, even if you have taken a loan, you have taken for money from the pool of funds. Okay, but if that is not the case, then you have to just take the cost of that particular project's capital. So if you have taken, just saying that no, this loan I am just taking for this particular project, the moment project ends I'm going to repay off the loan or whatever. Okay, it's not from a pool of my existing funds, then you will have to do it that way. Project is relatively small, so any change to the company are insignificant. So on all these criterias you can use old WACC. That is, if your debt to equity remains same, if your operating risk is also same, your financing is not project specific, and the investment is relatively small. Okay, then you can use old WACC, or else you will have to recalculate WACC. If any of these criteria are not met, it will not be appropriate to appraise the project using historical WACC. Okay, so now moving on, marginal cost of capital, that is the increase, the extra cost of capital because of the changes in the capital structure or business risk. Okay, business risk is made of both operating risk and financial risk, so keep that in mind. If capital structure is unchanged by the finance raised for an investment project, it may be appropriate to use the marginal cost of capital rather than the WACC. Okay, if so the marginal cost of capital, if a company gets a specific loan or equity to finance a specific project, then this loan or equity is the marginal cost of capital. Very straightforward. If you are taking a specific financing, then you are going to use the cost of that specific finance. It is the additional cost that the firm will have to pay on an additional dollar of capital raised. This is the meaning of marginal cost. So marginal cost of capital is nothing but the cost of new capital raised. For every additional dollar that you are raising, what is the additional cost that you are incurring? That's your marginal cost. Then comes risk adjusted WACC. A risk adjusted WACC is needed to calculate the project's NPV. Wait, before we do this, people asking for a break. So, okay, we'll take a quick 10 minutes break, and then we'll continue with risk adjusted WACC. Okay, so a 10 minutes break.
All right, welcome back. So let's continue. Now, as we were discussing risk adjusted WACC. So, in our WACC, it's made up of cost of equity, cost of debt. Now, in cost of equity, we can recalculate our cost of equity taking into consideration the new debt, the new risk. Okay. Now, risk, as we discussed, can be operating risk, okay, or your financial risk, or a combination of both. So risk adjusted WACC is needed to calculate a project's NPV if the financial risk of the company is expected to stay constant, but the business risk is expected to change significantly as a result of undertaking a project. Okay, so maybe your debt to equity level is the same, but you are entering into a new type of business. Okay, then you will have to readjust your WACC as per the new risk. Or if the business risk is if the business risk of a new project is different from the business risk of a company's existing operation, the company shareholder will expect a different return to compensate from this level of risk. So if you are currently in the petrochemical business that has its own set of risk and you enter retail, okay, now that would have a different gamut of risk. So the shareholders will, according to those new business, would alter their expectation, the return expectation. Okay, so if the risk is different, the returns expected will also be different. Hence, the appropriate WACC which should be used to discount the new project's cash flow is not the company's existing WACC, but a risk adjusted WACC which incorporates the new returns which is required by the shareholder. Okay, so from an exam point of view, if you see that the WACC is given, the old WACC is given, but you also see that the company is venturing into a new type of business, it's an indication that the business risk is changing. Okay, and therefore we cannot use the old WACC. We have to calculate a new WACC, a risk adjusted WACC. Right now, this could happen either for that also when your debt to equity level would change. Okay, that's when again you will have to recalculate your WACC. Now, there are two types of beta. Now, how do we calculate this risk adjusted WACC? As I said, there is already cost of equity, cost of debt, and then the proportion of it. Now, cost of equity keeps changing because of various reasons. Business risk is there, your businesses, as in your operating risk is there, and your financial risk is also there. Okay, so there are two types of beta. One is called the asset beta, which is the ungeared beta, which measures the business risk of the company. Okay, it's as if that it is an all equity finance company, zero debt company. You are removing all effect of financing from that beta. Okay, so whatever you are left with is the business risk alone. Okay, and then there is something known as equity beta, which is what we take in the CAPM model. We always use equity beta. So it measures the business as well as the financial risk, that is operating and financial risk of a company. Okay, it is called geared beta with proper gearing. Asset is ungeared beta. Now, don't get confused. Some people they feel that oh, equity beta means all equity company. No, okay, don't get confused that way. Asset beta is all equity. Equity beta is both the value of, as in business plus financial. So whatever the debt brings as a risk, that also gets included in equity beta. It's like the overall. So note that all equity finance company has only asset beta. Wait just a moment. Yeah. So note that an all equity finance company has only asset beta, and the geared company has both asset beta as well as equity beta. So if a company does not have any debt component, it's a debt free company, then all it's going to have is asset beta. Okay, and if the company has some debt to it, then it will have both asset as well as equity beta. Okay, so sometimes in the question, say if the company has zero debt, then you can just stop at asset beta and continue with your CAPM. Okay, so you need not re-gear them. Suitable discount rates for the project should reflect both its systematic risk and its level of gearing. Okay. Now, if you see an ungeared company, which is all equity finance, so it has only asset beta, reflects only business risk. And if it is a geared company, so it will have an equity beta, which has both equity as well as financial risk. Now, beta asset reflects purely the systematic risk of the business, whereas beta equity reflects the systematic risk of the business area as well as the company specific financial structure. See, understand beta as a whole is a systematic risk, is a measure of systematic risk. So, beta asset will just show you the systematic risk relating to the business area. Okay. It won't reflect the unsystematic risk, but the systematic risk relating to the business area. Right. Now, how do we calculate this risk adjusted WACC? Now, the calculation is super simple, right? There are just certain steps that needs to be followed. When we tomorrow we'll be solving questions, you will see in one of the questions, maybe we'll be doing tomorrow or the next 3 days, we are just going to be solving questions. Okay, so over there you will see how these recalculations are done. Here we'll just I'll just explain you the steps. Okay, firstly we need to determine, do we need to adjust the WACC or not? That's question number one. How do we find out if there is a new business that the company is entering into, or the debt to equity, whatever? We have discussed all of that. So any of those reasons, if uh, that is materializing, then we cannot use our historical WACC. We will have to risk adjust and recalculate our WACC. Okay. So once you find out that, yes, I need to recalculate my WACC, then the next step is finding the proxy beta. Okay. So you will find, say, for example, you are entering into a new business of, say, telecom. Okay. So you need to find the beta of either another similar, like whatever size of your company is, a similar sized listed entity who has a beta available. If that is not possible, then take the industry average beta. Now, to that industry average beta, you can make certain adjustments if you want. Say, for example, the industry average is uh, 2 times, okay, and you feel that no, I'm actually safer than industry average. Then you can assume it that okay, I'm not 2, I'm maybe 1 point. Okay. Anyways, that you need not be doing. Okay, from exam point of view. From exam point of view, you will take the proxy beta, which could be either of a similar listed company, or it could be the industry average. Okay. Now that beta includes both business and financial risk. So you de-gear it first. That is, you are removing the financial risk out of it. Okay. So now you are left with asset beta of the industry or of that similar company. Okay. So asset beta of the proxy equity beta is now available, which reflects purely the business risk. And then you put in your gearing, your financial risk. Okay. So it's called re-gearing it. Okay. Re-gear it with your personal debt to equity structure, and you will be arriving at the new beta, which is relevant to your company or to that project. Okay. So step number one, find the appropriate equity beta, or before that step, I would rather say first find out whether you need to adjust or not. If you need to adjust, then yes, first step will be find the appropriate equity beta to match the business activities of the projects from a suitable similar quoted company or industry average beta. Adjust the available equity beta to convert it into asset beta. The whole process is called de-gearing. Okay. And then we readjust the asset beta, that is in step number two, whatever beta we found, the asset beta, we are going to re-gear it, okay, to reflect our own or the project's debt to equity level. Okay, so readjust the asset beta to reflect the project's, that is its own gearing levels, which is called re-gearing the asset beta to convert it into equity beta based on gearing levels of the company undertaking the project. Okay, and then you use that equity beta, the new equity beta, to calculate your cost of equity through the CAPM formula. So you will arrive at the new cost of equity, which can be used in WACC and which is ultimately used to discount the future cash flows and arrive at the net present value. All right, that's the entire process. So very typical for a 10 marker, as in for your case study, high chances, because see, you are going to get a question from NPV, and there's a high probability in the NPV calculations you will be asked to calculate your cost of equity, cost of debt, and therefore calculate your WACC, then use that WACC to discount cash flows. Okay, high chances. Now, how do we do the gearing and ungearing? The formula is the same. Okay, so the asset beta formula given to you in the exam is beta asset is equal to beta equity into value of equity divided by value of equity plus value of debt into 1 minus t. So just remember this formula. Okay, it is very simple. It is in fact very similar to your WACC formula. Okay, beta of asset is equal to beta of equity into value of equity divided by the total capital, you could say. Like somewhat. It has similarities to your WACC calculation or the WACC formula. Okay. Wherein VE stands for value of equity, VD stands for value of debt, and T stands for corporate tax. BE is beta equity, BA is beta asset. Beta asset, remember, is your ungeared beta, and beta equity is your geared beta. All right, with this, we are done for the day. Okay, I've just shown you the formula and the steps, how we do it. Now, calculation part, when we are solving problems, that's when we'll cover it. So we are actually done for the day. We are done a little early. Okay, no problem. Maybe during solving, we may go a little overboard, 10, 15 minutes here and there. Okay, so bear with me at that point of time. For the day, we are done. So thank you so much for your time. I hope the concept of ungearing, regearing, how CAPM is. See, I could have taken this entire session in a very short format, but this I took from the point of view, or especially for those who are just who has an exemption to FM or who has done FM way back and has forgotten all these basic concepts. Okay, so when you are actually doing your AFM, all they will just discuss is that how to regear and which scenarios we have to regear. That's about it, and the formula of CAPM. That's it. All the backstory is ignored, but we don't want to be robots. We need to understand how it's being done. We need to understand practically, if tomorrow you actually have to implement and calculate these things, how it's done. In fact, in my classes, those who are my students, older students, would know that I actually show live examples of how even discounting is done. Because at the end of the day, WACC is required even for DCF valuations. So WACC is super crucial. And one of the important elements of WACC is cost of equity, because cost of debt is relatively easier to find. And in cost of equity, you need to understand these concepts in order to apply them properly. All right, so that's my time. I hope I was able to add some value to you. Thank you so much for your time. Have a great day ahead.